Good morning, everybody. Welcome to this webinar presented by TreasuryONE and ETM Analytics. With me is Andre Celia and George Glynos. Interesting times. That's how I will start it off because volatility is here. It's up and down. It's all over the show. We see the US equity markets down for 4 days in a row. Then all of a sudden, some announcement again. It rips up 12% on the Nasdaq, 9% on the S&P. It's interesting times. It's volatile times. So I'm not going to speak too much. I'm going to hand over to George to tell us about what's happening in the markets and how the tariffs are impacting us. But at the moment, it's the markets are headline driven. It doesn't look too much about data at this stage. It's all about what Trump is going to say. So, George, over to you. What is Trump going to say? Or have you got the crystal ball out there for us?
No, my crystal ball, I smashed it about 2 weeks ago because it wasn't working then already. I don't think it's working now. So now we've got to take Trump, you take him at face value. And much to my colleagues' dismay, every day they wake up, we try and prepare ourselves for the day ahead. So typically what we do is write some reports the afternoon before. And then when we get in first thing, bright and early in the morning, after we've put all of this effort in the previous day, we try and tweak the report, and then we can send it out nice and early, and our clients get, well thought out, written and considered research. We can't do that anymore because what tends to happen is quite late at night or overnight, we get these announcements that come through, and it's not that these announcements are meek and mild. They tend to have quite a big effect on the market, like we saw last night. And so we'll end up rewriting everything the next morning. So there's it's crystal ball times, I think, out the window. But there is a very interesting dynamic that's at play at the moment, and it's worth maybe just going through some slides just to give us a sense of what's going on. So Vikar, just let me know if the slide has changed on your side, just so that I know that it's all working.
It has changed. Before you kick off, I just want to say to everybody, if you've got any comments or questions, please ask them in the comment section, and we will tackle them as we go along to make it as interactive as possible. So sorry, George, just wanted to say that.
Yeah, absolutely. There's nothing scripted here, so we have a conversation, and as a result, please stop us whenever. So the first thing is just to kind of calibrate our own thoughts as to what's going on at the moment. The chart on the left is the average rate, the average tariff rate of all imports across the board. Now, this this was done yesterday afternoon when we knew that Trump had just levied more tariffs on China. And at this point, he hadn't pulled back on the 90-day tariff pause and dropping it back down to 10%. So that dark blue line is effectively what it was prior to his 90-day pause. So actually what you need to do is bring that solid blue line on the left-hand chart just down towards the 10% mark, a little bit lower than where it is now. But you'll see that it's still, the highest tariff levels in the US since the Great Depression, days of the Great Depression. So you're talking about, the 1940s, which is quite something. It's not often I get to compare our current situation to the 1930s and the 1940s, but I am doing it at the moment. The chart on the right gives you a sense of what Trump has done in a very, very short space of time concerning China. And here you see there's been a dramatic shift higher and got shifted higher again. So I did capture the last little bit of that tariff increase up to 125%. And, China could respond as they did the previous day. And so America will just keep going and China will respond. And to be quite honest with you, it gets to a point where the tariffs are so high that it starts becoming irrelevant. The tit for tat thing starts becoming irrelevant. And we're not far off that point right now. So, if you've got tariffs of over 100%, you're effectively doubling the price of the doubling the price of the product, which naturally is going to impact any market, regardless of where you are, to the point where suddenly people are probably going to stop buying it and looking for alternatives. So we think that we're already at that point where demand for some of these imported Chinese goods is going to be dropping off extremely sharply, much to America's pleasure, because they want to start relying less on China. That's one of the stated objectives, and to start reclaiming some of the control over their economy, their expenditure, and production. So when looking at these tariffs, you try and ask yourself, okay, but exactly what is he trying to achieve? So one of the things that he has stated openly that he wants to try and fix is the fact that the current account deficit on the left-hand chart, the blue line, has been deteriorating sharply ever since the US decided to abandon the gold standard back in the 1970s. So they abandoned the gold standard. It allowed the central bank at the time a lot more flexibility to move monetary policy. The central bank then realized that it could move monetary policy in such a way as to stimulate aggregate demand through lowering interest rates. And it gradually appeared to become more and more palatable to do so. And in the process, what they did was encourage a lot of consumption above production. So, when you're constantly reducing interest rates and it becomes cheaper and cheaper and cheaper to borrow, over time, that does tend to encourage consumption. And that consumption above production means that you are spending a lot more than you're producing, and that results in what's effectively a trade or a current account deficit, which is what's reflected. Through the course of the sophistication or the growing sophistication of many developed markets, what you also find, and it's a natural evolution that takes place, and it's happened in the UK, it's happened in Europe and elsewhere, you'll tend to find that an economy starts to shift more and more and more into services and less into production, for the simple reason that services require a higher end skill and production requires a lower end skill. So those countries that have got the lower end skills that are cheaper than the more developed economies that have got higher end skills that are more expensive is where production is going to gravitate to. Obviously, you want the lowest factors of production to dominate your production schedule. And so if you can produce cheaper than the next person, that ultimately becomes your trade advantage. That's what happened to China. And the picture on the right shows exactly what is scaring America and scaring the Trump administration. They feel like they've lost control at the moment, and it's reflected in that trade account on goods plummeting, as the black line shows, versus the surplus on the services account, which is moving in exactly the opposite direction. So one of his stated objectives is to try and bring a little bit of balance back into this picture. If you're going to consume a lot more than you produce, what you also land up doing is through the course of time, borrowing money in order to do it. So you can only spend as much as you produce unless you borrow the difference between what you're spending and what you're producing. And that's essentially what the progressively lower interest rates over a long period of time in the US has done. And it's not surprising that it's not just at a private sector level that's happened, but it's happened at a public sector level as well. And so you've had the budget deficit through the course of time, and you can go again all the way back to the 1970s, and you'll see if you had to draw a trend line through this particular chart, it would be sloping down. In other words, your budget deficit would be deteriorating more and more over time. And this is something else that the Trump administration has decided is unsustainable for very good reasons. So if you have a look at the interest burden on debt, which is the left-hand chart, you'll find that it has escalated very, very sharply ever since the pandemic hit, and they borrowed very aggressively in order to try and stimulate the economy to ward off a huge recession at the time. Except that now what they're finding is that it's very difficult to rein in a lot of that expenditure. And if they sit on the current trajectory, by the Congressional Budget Office's own projections, this is what the interest bill on that debt would look like. So there is logic to what the Trump administration is doing. When you see that they are trying to trim the size of government, and currently at the moment they are debating how they are going to cut their budget deficit by approximately $2 trillion over the next 10 years. That's over and above any savings that Doge brings, and any other taxes that they may raise through tariffs and the like. So they're trying desperately to find trillions here in order to stop this budget deficit from deteriorating. They would be targeting to try and halve it within the next 2 years, and to get it to a point where it is smaller than GDP. At that point, your debt levels relative to GDP start to come back down again, and the situation becomes a lot more sustainable. But in order to do that, it requires a lot of austerity, and that austerity comes not just in the form of trimming the size of government and cutting back expenditure very, very aggressively, but in this particular instance, they've done it, or that they've been targeting tariffs as well. So unsurprisingly, all of that has resulted in Trump's approval rating steadily declining. And when I had a look at the betting sites to see whether or not Trump's approval would be greater than 45% on the 1st of May, the betting market now shows that the chances of that happening is a mere 20%. This has dropped from an approval rating of closer to 80% at the beginning of the month. So in just the space of a couple of weeks, you've had this very, very sharp deterioration in Trump's approvals as a result of the tariff imposition and the movement that we've seen in financial markets. A lot of people are obviously concerned and believe that that's not what they signed up for. They signed up for greater efficiencies and the rest of it.
George, can I quickly just stop you quickly?
Yes.
Before you go on, here's one question that you've got already is Kobus Lurtz has asked, is it possible that damage to the world economy can be undone in the medium term? If not, what are the implications? And I just want to add to it is some of the things that the Trump administration is trying to administrate is trying to get interest rates lower because you spoke about the debt and trying to refinance debt at cheaper levels because if interest rates are up here and they got to refinance, obviously the interest bill becomes a lot higher. So how does it look?
Yeah, so in answer to the question, I don't think we even need to wait for the medium term. I think things can turn around extremely quickly in the short term. And I'm talking about a matter of months. If a lot of it depends on how the rest of the world is going to respond to Trump. If the rest of the world is going to respond to Trump in the way that China has responded, then it's going to be very negative, and the fallout across the globe is going to be enormous. If, however, they respond to Trump like there are many countries that have now approached Trump and said, oh, listen here, you're calling them reciprocal tariffs. So if we drop our tariffs to zero on American goods, will you do the same in return? And the answer to that is yes, we will consider it. So if what comes out of this is more and more countries opting to reduce tariffs to zero in order for the US to drop its tariffs on them, then all of a sudden you've got a situation where Trump, whether he did this by design or whether it's just happened to be the response that's turned out to be the most favorable, has potentially in a very short space of time forced the global economy into a situation where there are a lot more tariff-free zones, in other words, free trade zones popping up all over the world. And South Africa would do well to consider its position and the fact that it can jump onto that bandwagon too. South Africa's got the enviable position of being the world's biggest platinum producer, PGMs producer. We know that America requires those PGMs for their vehicle industry. We also know that America is at the moment looking into huge investment. and energy infrastructure. And for that, they will require greater quantities of coal. South Africa has both in abundance. And so we have a strategic option to be able to go and negotiate with the Trump administration and say, look, we're very happy to reduce our tariffs to zero. And let's talk about how we can further the importation or the trade of PGMs and coal, which would be in the US's interests as well as ours. And as a result of that, let's talk about preferential treatment in terms of trade, etc., etc. South Africa's complicated their lives immensely with these really ridiculous geopolitical positions that we take. But be that as it may, on a trade, on a transactional basis, there is a lot that South Africa can do to help itself. It's not just South Africa. There are many countries around the world that are looking at doing exactly the same thing. So if we get to a position of zero tariffs being the outcome of what's going on at the moment, this can turn massively positive very quickly. So we're waiting to see how the globe responds. There have been some countries. Europe is considering a free trade zone with America now, and they're considering a zero tariff regime because they realize that is significantly less damaging than fighting Trump on tariffs and then watching him impose counter tariffs and backwards and forwards like that. That helps nobody. That's tantamount to cutting off your nose to spite your face. So I think a lot of countries have realized this and are potentially shifting their focus. So Vekor, I hope that answers the question. And then just getting back to the presentation and the efforts that they're making. Also bear in mind that we need an America that is sustainable over the long term. We don't want an America that is under pressure for an inability to sustain its debt trajectory and its debt levels. So we need America to sort itself out, and it can lead the way in showing many countries around the world that constantly borrowing into the future is not the way to go. So we are watching what's happening with this Department of Government Efficiency. They are targeting $1 trillion worth of savings in the first year. So far, they've accomplished $150 billion worth of estimated savings, but it's going to be difficult. It's going to be really, really difficult to shrink it significantly further. Because more than 64% of the budget goes to spending that's not easy to reduce. And you look at all of those: Social Security, Medicare, defense, education. Which one are you going to trim? And which one is going to have the least impact, least damaging impact on the economy? All of these things are important, and so they all fight for the fiscal wallet. The problem for Trump, of course, is that these tariff threats have already had an impact on the economy, and you can see it in the GDP now figures on the left-hand side. They've dropped off very, very sharply, mostly because a lot of importers have imported preemptively. So they have looked to cut, they've looked to their exposure to these tariffs by importing a lot more than they needed up front, but in the process, they've dropped net exports very, very aggressively, and that net exports has had a negative impact on the GDP now figures. So it suggests that the US is going to go into a bit of a downturn through Q1 and Q2 of this year. But whether or not it's a sustained downturn is going to depend on whether on what the response is going to be from the rest of the world. We also know that there's been a big surge in inflation expectations in the US as a result of these tariffs. But interestingly, these inflation expectations don't always have an impact immediately. Sometimes they operate with a lag. That lag can be up to a year. So right now we think that the jump up is more fear-based. It wouldn't surprise us at all to see those numbers, those expectations come back down. If you look through 2022 and 2023, you'll see spikes in inflation expectations, only for them to reverse shortly afterwards. We think that we're in that kind of scenario right now. So we're not paying too much attention to that. For the time being, the expectations are still that the US is going to cut interest rates through the course of this year. So what does Trump hope to accomplish? Well, we think that he wants to reset the global world order of trade. And that means conducting business very, very differently. He would like to try and find a way for the US to reindustrialize. I think it's upfront, it's going to be very difficult to do, and it's going to take multiple years before that ever comes to fruition. But every journey of 1,000 miles starts with the first step, and if you've got to be bold enough to take the plunge to go down this route to see if you can reestablish some of the industrial base that the country's lost through the course of time. The other thing that he wants to do is retain IP. So he wants to stop seeing American companies going over to China, having their IP stolen, losing some of the technology that's been built within America, only for it to be replicated and possibly improved on or bastardized, as has been the case in China, to such a degree where they lose their first player advantage. So retaining IP is very much part of the first objective. And then, of course, it goes towards regaining control of technology, because technology and the control of data, AI, and these data centers is going to be what drives international growth going forward. And for the US in particular, it's going to be key to national security and the military. The second objective is that he wants to extend US hegemony, in other words, the power of the US over the world. And the way that he can do that is by rendering the US more sustainable. So he'd want to do that through reducing the budget deficit and improving the fiscal trajectory. And he wants to ensure that the dollar remains a reserve currency. If the dollar is constantly being bailed out by the Fed and being printed up, etc., that doesn't help the dollar's cause over the long term. Over the long term, you will steadily destruct the value of the dollar. So he wants to try and turn things more sustainable in order to ensure that the dollar remains the reserve currency, because quite frankly, you get a tremendous amount of benefits if you have a reserve currency. The third objective was to expose China, and I think he's already started to do that. Because whilst many countries around the world are talking about zero tariffs, China is ramping up against the US with more tariffs. And he's turning around saying, you see, these guys were never into fair trade anyway. They wanted it all their way. They've done it for years and years with unfair labor practices. They haven't stuck to WTO rules and regulations in the way the rest of the world has gone. And because they've been so powerful and so cheap, the world has just tolerated them, but it's taken somebody like Trump, who is prepared to stand up to China to call them to account. And I think this is feeling quite uncomfortable for China. So he's looking to expose China, which I think he's doing at the moment, and he's wanting to force them to change their trade practices and specifically their non-trade barriers. So that's in a nutshell my expectation of what their objectives are. The three possible scenarios that I see playing out here are, in my opinion, the following. So the best case scenario for us is that the reciprocal tariffs and people and countries negotiating on a zero tariff reduction, so that we get free trade agreements around the world, I think would be a fantastic result. I think the world would be a lot better off without these tariffs. And if you can negotiate these zero tariff free trade agreements, I think this is what we should be aiming for. For those countries that do that, they will get all the US's support, from military support to technological support, etc. That is the best case scenario. The most likely is something probably not as positive as that, but where Trump is going to segregate different countries into various groups. So the first group will be kind of like your best case scenario above, where they will foster free trade, where the US will support them militarily, technologically, etc. The second group will be countries, and potentially South Africa sits more in this particular group, where we have lower tariffs to offset non-trade barriers or whatnot. You'll still enjoy some support militarily wise from the US, although in South Africa's case, we'd have to fix our geopolitics. But we'd get limited amount of tech support. And then you'd get group 3, which is where China would sit, where you've got high tariffs, a trade war, no military support, a very acrimonious relationship with the US. And they could segregate the different countries around the world depending on their response and their relationship and their discussions on the trade front. I think they group them into these different groups. The third objective, the third scenario, that should read scenario, not objective, is a full-blown protracted trade war around the world. And the reason I see that as the least likely is because it literally hurts everybody. The more people or the more countries respond to the US with their tariffs, the worse it becomes. It's far from clear that countries just want to engage in a full-blown tariff war with the US. I don't believe that's the case. I think they could just not respond and instead just steadily through the course of time trade away from America and trade amongst themselves and minimize the damage that way. But a full-blown protected trade war is not my core outcome out of this. I would be sitting in scenario 1 and 2. Between the two of those, I think we'll probably get closer to where I think this ultimately settles. So that's
before we move on, just to add on to that tariffs is Willem is asking, what's the value of any legal agreements like AGOA and bodies like the World Trade Organization if Trump, or that matter the US, do whatever he wants despite all the deals in place?
Yeah, those AGOA agreements, you can write it off. It pales in comparison to the tariffs he's already imposed. So AGOA it's a moot point. It's irrelevant. It doesn't count. It doesn't matter anymore. So he's overwritten all of those with his executive orders, and he's imposed the tariff. So South Africa, as we speak right now, is sitting with a 30% tariff on any goods exported to the US until we negotiate differently. So that's the situation. And it's not just the case with South Africa and AGOA, it's with all countries around the world. So those previously standing legal for what they're worth agreements don't really matter.
Okay, but George, I think the crucial point there is that if there's a legal agreement and you can so easily override it, then even a free trade agreement that gets negotiated between two countries can, at the free will of one person, be changed. Exactly like he's done now with AGOA, for instance. So what?
Yeah, I think, Andre, that's
the legal agreement doesn't hold any water, then what's the point of having any agreements?
Well, because you still want some sort of an agreement rather than no agreement. I mean, you need a basis of which to trade. And so if that's what he's going to trade on, then, that's what you've got to do. He's the big dog in the room. He can kind of dictate terms. And if you don't like them, don't trade with him. That's kind of like his take it or leave it argument. And unfortunately, the rest of the world's not in a position to push back unless you want to go into a full trade war. You can do that. But I think it's a destructive thing to do, and I don't believe that you're going to accomplish very much doing it. So at this stage of the game, I think it's very much a case of the US is dictating trade terms around the world. That was his objective, was to reset the trade world order, and that's what's unfolding at the moment. And whether you like it or not, that's the way it's going to be. So, yeah, I mean, you're right, Andre. Those legal agreements don't count for much. The World Trade Organization exists to avoid this kind of situation, and he's basically given them the middle finger. He's said, well, we're not going to be dictated to by the World Trade Organization. We're going to conduct trade in a way that interests us and which is in our best interests. And if you don't like it, don't do trade with us. But he knows that he's 34%, I think it is, of the world's trade demand. So he's in a position where he can do these sorts of things where most other countries can't. And that's the cold reality of it. So, is it bullying? Of course it is. Is it pleasant? No, it's not. Is it going to be successful? Well, time will tell. But it's the option that he's taken. It's the strategy that he's adopting, and he's going to deal with it on a case-by-case basis. I think the transactional nature of the man and of the administration is what's going to dictate terms and how things unfold over the next couple of years. Vikot, I'm mindful of time. I can go through the rest of this presentation where, going to the global backdrop and whatnot, and I can scoot forward to some of the South African charts as well. But I know we're just over half an hour in. Would you like me to continue with this presentation?
Or
should we open it up for Q&A?
I think
George, if you could, if I look at the questions coming through, I think it's the questions that's at the forefront of a lot of people's mind. But to get there, I think one needs to have some insight as to what happens in the South African market. So maybe you should fast forward a little bit to, I think most people by now has got a grip of what kind of happens in international side and with the American economy. Maybe a quick one on the SA economy and then jump into the questions.
Cool.
Everybody wants to know the run.
Yeah. So let me do exactly that. Let me just jump through. So just also to say, for factors that are going to affect us back here, I think it's worth just pausing on the dollar, just talking about the dollar a little bit, just to make the point that the dollar right now is in a very overvalued position. As you can see, you'd have to go all the way back to the early 1980s before you get a dollar valuation this expensive. So we're at unsustainably expensive levels right now, and that leaves the dollar a little bit vulnerable. We know that over recent years, and very typically over the pandemic, that this whole US exceptionalism argument has been a big factor that has kept the dollar really, really strong. But that US exceptionalism is now fading for two reasons. The outlook for the US economy is softening, and interest rates look like they're going to come down. And the combination of both those things could very well lead to an unwind of the dollar to some degree. We know that speculators, for example, are no longer as bullish the dollar as they used to be. And so that blue line being as subdued as it is suggests that there's not a very strong speculative element for the dollar, or there hadn't been up until perhaps the past week or so. But there's some bigger factors that are at play here as well, and that's what's going on geopolitically over a longer period of time. And what we've seen is a lot of foreign selling of US treasuries by big central banks. And the reason that's important is that we've noticed that the lower the participation of these big demanders of US Treasury historically, the lower that demand is over a period of time, the weaker the dollar tends to perform. And so we think that there are more than one reason why the dollar should come off from its peak at the moment. And the implications for South Africa are quite literally, if you go into a downturn in America and you've got a VIX that spikes, there's likely to be a sell-off out of emerging market bonds, which is the blue line in this chart. So that black line, by the way, is inverted. So that VIX spiking, and by the way, that black line dropped quite sharply through the course of this week. It just hasn't updated yet on this chart. Means that emerging markets are going to be looked at a little more closely. So quickly getting on to South Africa, the situation has improved in some ways, deteriorated slightly in others. That green line we were hoping was going to drive a little bit higher, but unfortunately with the developments that we've had with the GNU, that green line has come back down again. The green line is the short-term cyclical reflection of how the South African economy is performing. The black line is your longer-term structural position of the South African economy. So it still sits in adverse conditions. The green short-term cyclical line is barely buoyant, but kind of neutral. We were hoping that was going to be a little bit better. On the presidential policy scorecard, it looks like there's been some improvement, but the data just hasn't been updated to what's gone on in at the end of March and April with the GNU. We think that these lines are going to tick back down again. So a lot of the positive sentiment that had been generated by the GNU, we think is going to detract from both the first and the second chart that I showed you. Unfortunately, it's already been reflected in the latest consumer survey, consumer confidence survey produced by the Bureau of Economic Research. That pulled back quite sharply. And it all tends to relate still to what happened with the budget and the fact that, we don't believe that we have serious control over our fiscal position. The way to go about resolving our fiscal position is not through increasing the VAT rate. It's by making the government more efficient and shrinking it, turning it more professional, ditching things like cadre deployment, etc., etc. You can keep me going like this for a day. But really, this is the unfortunate picture, is that our debt service costs as a percent of revenue now occupy a fifth of our budget, which is crazy, or a fifth of our revenues, which is crazy. So our debt trajectory, they constantly talk about it topping out and tapering, but on the current trajectory, unless we get some significant reforms being implemented, the potential risk is, as is reflected in this current chart, which is obviously not constructive or helpful to South Africa. So it ultimately means that whilst we continuously waste money with a very inefficient government, we have less money to spend on things like infrastructure. And so if you had to ask me for one indicator that would give us the best sense of whether South Africa is turning around or not, I would probably pick this one, which is gross fixed capital formation as a percent of GDP, or in other words, fixed investment as a percent of GDP. That figure needs to be above 25%. We're a long way off that, and in fact, this government has a lot of work to do. The GNU so far has produced very little in the way of concrete proof that there's better times coming. So they need to work hard for the South African population to turn things around, because as things stand, we are unable to take advantage of the commodity cycle that has happened, primarily because between the logistics, the ports, the infrastructure difficulties that we've got, regulation, etc., and mining constraints, we simply haven't been able to respond, which is tragic for a country like this, because the mining sector, for example, could have employed a lot of people and reduced the overall unemployment rate. So we doubt that the GNU at this point in time, unless they pull themselves together, is going to live up to the hype. We don't think that the GDP forecasts are going to be matched. The latest GDP forecast is that dotted line. That for me is looking a little bit like a pipe dream at the moment, unless this GNU sorts itself out. So there's a lot riding on this GNU. It's unfortunately not looking good at the moment, but that is the situation where it stands. So where does that leave us? Well, our interest rates are still elevated as a result of the amount of risk that's being priced in. So on a nominal interest rate basis, we're still holding our own in terms of carry attractiveness, which is, well, thankfully we still have that. Although the outlook has deteriorated, and so the FRA curve has shifted very quickly to price in the probability of 2 interest rate cuts through the course of this year. We'll see if those materialize or not. So much is going to depend on what unfolds in the US and how the stock markets, etc., respond. But the Rand has had a tough time, and it would be a mistake thinking that the Rand's difficulties are a function of Trump and his volatility. It's been very much and a lot more a function of the tensions within the GNU and the potential splintering of the GNU. That has been the Rand's big bugbear over the last couple of weeks, and it's unfortunate to see. a currency that was performing reasonably well, that had lower levels of volatility, suddenly spring to life in the wrong possible way. And that black line is us. You can see how we've deteriorated very, very sharply versus many other currencies around the world, which is frustrating because when you have a look at our terms of trade, they're well elevated. South Africa shouldn't, the rand shouldn't be performing like that, but thanks to our politicians, we are. So in terms of our valuation range, we're back into value territory for exporters. Exporters should be using and would have had a golden opportunity yesterday afternoon to lock in some attractive forward rates and to repatriate some of their foreign earnings. We think that there's some undervaluation in the rand at the moment, so there's the potential for it to come back to at least the 19 handle, if not break below, and go back to sort of an 1850 type level. We think that's quite possible. Our rand sentiment indicator remains in positive territory and suggests that there is still some life left in this currency, if only our politicians would get their act together. So our rand sentiment indicator is saying is agreeing with the previous chart, which is totally different metrics, but saying the same thing, that rand could still stage a recovery over the next few months, depending on what happens with the GNU. So ultimately, this is where it leaves us. We are anticipating further interest rate cuts, a repo rate going down towards 7 or just below. We think that inflation for the time being remains under control, so that's not really going to be a big problem. Your bigger problem is going to be the volatility in the rand, and as I've said before, that's very much a function of our darling politicians. So with that, Richard, I'm open to take questions, and I'll stop sharing my screen so that I can see people.
Yeah. So George, obviously one of the questions was, what is the short-term range for dollar rand? And then the follow-up question, sort of you tackled it already, I think, is how much of the rand's recent weakening was due to Trump and how much is linked to the instability in the GNU? Okay, so you said more GNU related than Trump related. But I've got a follow-on question on that. If this afternoon the DA comes and says, we are walking away from the GNU, don't you think we see another rand, the rand go weaker by another rand on instability?
Yeah, I don't know if it goes as much as a rand because there's a lot of negativity that's already priced in. 50 cents, yeah, I think that's possible, and it would be really unfortunate. You see, this is the interesting thing. These financial markets, to my mind, are also holding the politicians to account. The politicians are going to know that if they do something stupid, that the currency is going to tell them that they've done something stupid. The same thing with the bond market. And so there is pressure building. It hasn't surprised me that Ramaphosa's extended a bit of an olive branch to the DA, that the IFP wants to speak to the DA. They want to try and hold this government of national unity together, because the alternative isn't great for the ANC, and it's not great for the DA either. From the ANC's perspective, they're still far from certain that they're going to be able to pass the 2 bills that they need in order to enact the fiscal framework. It's one thing to pass a fiscal framework. It's another thing completely to turn it into a reality. And for that, you need the appropriations bill and the other bill, that the division of revenue bill that needs to be passed. Both of those are not going to pass without the smaller parties. And the smaller parties have turned around to the ANC and said, well, scrap the VAT thing, or we're not voting with you. So the ANC is not out of the woods yet. All they did was, crow about a fiscal framework that actually didn't house itself in any material bill that could be passed. So they're not there yet. They're not over the line, which is going to be an interesting one. So the ANC is not, free and clear of this little debacle. They haven't taught anybody any lessons. If anything, they're getting taught a lesson that you can't just ram through things in a coalition government. And that the better thing to do would have been to sort this out long before you get to budget. But again, the ANC at the time was operating as though it had the right to be able to dictate the fiscal terms. And as it turns out, that's not entirely true. So I think there's going to be a lot more negotiation that's taking place, if it's not already happening in the background. And so I'm hoping that the GNU ultimately holds together. This is very much a function of coalition politics, and it's something that we're not used to. So every time we see a little bit of trouble, we spring up and think, oh, my word, it's all falling over. But if you go and have a look at coalition politics in other countries around the world, this kind of thing happens all the time. It's nothing new. To them, this is like, yeah, well, that's a coalition government. Like, get on with it. Just, grow up, become adults, and go and sort yourselves out for the betterment of the country. I think we're still learning how to do that. So let's wait and see how the next couple of weeks unfold. And I'm hoping that some sense prevails. These guys keep the GNU together. The ANC rethinks its budget. Everybody has their say, and they come up with something that actually holds some true reforms. I saw some of the Bosa suggestions, and they're good. They're good suggestions, shrinking the size of cabinet, the size of government, looking at ways to cut expenditure, efficiencies. This is the kind of thing we want to see, not more VAT hikes. That's lazy. It's a lazy way to go about doing things. So I think the ANC is learning a couple of lessons here as well. And so, let's hope we get a more constructive outcome at the end of the day.
Andre, do you want to add anything to that?
No, not really, apart from the fact that I still think that the whole debacle around the GNU, which I don't call a GNU, I call it's a government of national cooperation rather than unity. Unity isn't something that we're going to get between them, that group. But there should be cooperation, and they're battling with that. And it still has an impact. And if we go and look at one of the graphs that George had brought up, was the one of fixed investment into the country. That's not at 25%. It's hovering at very low levels. That simply says to us, we are being watched by foreign investors for investment into the country. And the GNU, as they call it, is one of the things that they're looking at. And unless that can get sorted out in proper cooperation and have a little bit of unity, the investors are not going to turn back. And if the investors doesn't turn back towards this country, then we have a problem, and it will continue to have a problem because we need that investment in terms of job creation and so forth. So they need to get their act together, and they need to stay off social media. There's too many people, each of them having their own little word. And the one morning, at 10 o'clock, you read one thing from one person in the party, and at 12 o'clock, you read something different from somebody else. They need to get their act together. I'm speaking about the broad spectrum of people here, a broad spectrum of political parties that does that. It's not doing anybody any good, and it will continue to have an impact on the rand, and it will continue to play havoc in terms of the volatility.
A follow-up question from Kobus Lutz is, internationally, does all of this point to a likely reduced American political and economic influence in the world over the medium term? If so, what are the implications? And then just adding to that, if China can't export to the USA, is there a real risk that they will dump those products elsewhere to keep the manufacturing going? And is this a risk for South Africa?
So the first question is an interesting one, and it's not an easy one to answer, because in some ways it's tempting to say, well, if the US is going to become more isolatory and turn inward, that it's going to reduce its participation in the global economy. And therefore lose some of its international power. Well, it's tempting to say that, and I know a lot of people would love that to be true. But truthfully, if Trump pulls this off and he gets a lot of free trade zones going, I don't think that will be true at all. The other thing to say is that if Trump gets it together and manages to implement some fiscal reforms that make the US more sustainable over the long term, I definitely don't think that's true, because they will enhance the dollar's attraction as the reserve currency around the world for a while to come. So, yeah, I mean, there's a lot of people that would love to see Donald Trump get a bloody nose and have less of a say in the global economy. I think they're going to need to be a bit patient before that happens on a grand scale. At this point in time, the US is still the biggest dog in the room, and the rest of us are having to just play his game, so to speak. In terms of the dumping, yeah.
I think if I can add to that, it would be difficult. There will be some sort of agreement at some point in time. It would be difficult for two big economies like that to stop trading with each other. And there's no ways that China would be able to take everything that was exported to America and go and dump it somewhere else in the world. As far as South Africa is concerned, South Africans simply does not have the spending power to absorb that quantity of goods. So there is the possibility of some dumping, but we do not have the spending power in South Africa to accommodate all of that. So somehow between China and America, there will be some agreement at some point in time. It might just take a while for that dust to settle, but they can't ignore each other. The trade is simply too big. That's my opinion.
On the issue of dumping, it's not that easy. We should, as a responsible country, have responsible trade rules and regulations. And America might not be abiding by World Trade Organization rules and regulations, but then again, neither is China. So, again, is it possible? Of course it's possible, but if we are astute in the way that we do things, we should be able to stop it. And so, it's going to come down to each country and how they handle it. You can stop dumping by just stopping dumping. You can put a stop to it immediately, confiscate the goods and destroy them if you wish. As a country, these things are possible, but the authorities will need to handle that. At this point in time, I don't have a very firm opinion on how that might unfold.
And then lastly, when I ended off by asking the difficult question that we started off is our local currency. We've been chatting about the rand trading in an 18 to 19 type of range with breakouts. We've had the breakout to the top side now. Are we in the medium term going to settle back into that 18 to 19 range, or are we heading for a new range? And the volatility, it's impossible to call it, but is 20 and 21 on the cards if the world goes pear-shaped?
I would say it is on the cards if the world goes pear-shaped, but I'm hoping that's not the case. So I would say, I mean, the range has already been established. I mean, we just about hit 20 yesterday. So, you'd have to say 20 on the top side. I'd go so far as to go as low as 18 on the bottom. That is a very wide R2 range, but we're living in very unusual circumstances. And I would say that levels closer to $20 to the dollar offer an amazing opportunity for exporters, and levels, back below 18 and a half, I think offer some opportunity for importers. And that would be, the more extreme, I guess, portions of my range.
Andre, if you want to add anything to that?
I'm not going to narrow trading ranges, but we've been in an 18, 19 range for a heck of a long time. What's happened in the last week or two has just widened that for us, with a lot of risk to the upside. So no, I'm not in a narrow trading ranges. 20 is still a possibility. and I've just said to somebody earlier this morning, like last night, things changed in 2 minutes. Yesterday afternoon, we were, 4 cents away from 20. This morning, we're 70 cents away from 20. And it was changed in 1 minute. There's a lot of minutes left in Donald Trump's period of reigning as US president. So, no, we're in for volatility, which means that we're in for a lot of attention and focus on risk management policies on how to navigate through this volatility so that we come out standing and stronger at the end of it. Because trying to call a level or trying to call a top will only cost you money. That's not the way to navigate through this volatility. So we would have to really just apply risk management principles.
And then there's a last question that just came through. It says, are we not underestimating the Chinese economy and the impact on reducing reliance on the USA?
Look, I'm not underestimating the Chinese at all. In fact, I have one chart which shows China and their collection of BRICS Plus overtaking the G7 within 2020, within the next 2-3 years. So there's no question that China is going to play an increasing role going forward. But China is not all good. And I think we need to get away from this idea that it's just America that's being bad. China has done a lot of unsavory things through the course of time. Stealing IP, regenerating technology that wasn't theirs, not allowing fair business practice within Chinese borders. There's a lot going on in that country that would not be allowed in countries like America or the US or Europe or the UK, Japan, and others. So, you need to also appreciate that in some respects, it's high time that somebody also held China to account. So now I'm not underestimating China. China is going to be a very, very powerful force going forward. And they can retaliate, but they're not as big as the US. And the US at this point in time is open to free trade zones with the rest of the world, or so it seems. Let's see if that unfolds. And if it does, China's going to look at their own trade relations and maybe be forced to rethink their situation a little bit. That's the way I would think about this. This is becoming a multipolar world. So it's not just the US that has a say on things. It will be others as well. China, the most dominant of those. But give it time. The dust needs to settle on this. And I think in that time, there will be solutions that are made, because ultimately people are transactional. I mean, Apple's got, for example, huge exposure to China. They're now looking at relocating some of their production and whatnot to India. That's a big loss to China, but equally, it's a big loss to Apple if they can't sell their products in China. So, there's a lot at stake here. And at the end of the day, transactions that ultimately benefit both sides will probably come to pass. But you're first going to have to get through this very messy patch that we're in.
I'm going to end off the webinar here. We're cognizant for time. But I want to say, what somebody says on the currency front that everybody's talking about is we've got to brace ourselves for volatility. There is still a lot of uncertainty that hangs locally on the GNU, how the budget is going to be passed. We've got the next 20 days at the end of April, beginning of May, to see if the vote goes through and how it's going to be sitting. So we've still got the local issues. Tariffs has not gone away. We've just got a 90-day pause on it. How it's going to play out in that period, we'll need to know. And like Andre and George said, is the range is wide. The risk is to the top side, because and George has also showed it, there's a lot of recessionary fears, just not in the US, but globally, that can play a big role. So there's a lot of factors up in the air. a lot of uncertainty, and the uncertainty will be with us for an extended period of time. So the currency will be volatile, and we got to manage it in these volatile times. But if you've got any questions, reach out to us, and we will gladly assist. By that, I'm going to say thank you for everybody attending. Thanks, George. Thanks, Andrew, for your time, and enjoy the rest of your week.
Thank you very much, Peter.
Have a good one.